founder of First Global and author of the bestseller Money, Myths and Mantras. In fact, Devina has just returned from the Kushwant Singh Literature Festival in Kasauli, where she was interviewed, of course, on her book. Devina, thank you very much for joining us and for flagging off my Diwali show. Well, for starters, actually this Diwali we're all entering with a bit of a FOMO. Oh, I wish I had put more money in gold. Oh, I wish I had got the LG IPO. There is a lot of FOMO in the market because secondary market has not made money. Why don't you start by telling us how should we address the gold FOMO?
Okay, first of all, the worst thing you can do in the markets is to have FOMO. So that's the part that always misleads you because we've actually seen the data. If you systematically chase whatever has done well of late, whether it is global markets versus India, gold, or if we go back further, it might have been PSU stocks or small cap. If you have FOMO and therefore you, for example, invest in the next thematic fund that comes along, you will systematically underperform. So if you chase the heroes of yesterday, you will systematically underperform. That's the data. So, and as Richard Branson said, opportunities are like buses. There's always another one coming along. So you don't have to chase yesterday's opportunity.
Fair point, fair point.
Just before this program started, I heard somebody on the channel say that gold has seen the biggest rise since 1979. So let us go forward and see what happened after 1979. So gold made a high in 1980, true enough. But thereafter, it was 27 years before it reached that high again. Oh. So that's the story of gold, at least in dollar terms. And in between, so from 1980, if I go fast forward 19 years to 1999, it was still down 60% from the high, 62% to be exact. That's the story of gold. Gold is actually no safe haven. It's been more volatile than equities in dollar terms. But on the other hand, our grandmothers were not wrong to buy the gold for Dhanteras and otherwise, because at that time you could not invest overseas. So gold was the only hard currency asset that you could actually buy. So it was very sensible because that was in real terms the only global diversification you could get. But now that is not the case. Now you can get through global diversification. So gold should be part of your asset allocation, but it should not be 25, 30% of your asset allocation. I mean, to my mind, for most people, gold and silver should be in single digit kind of allocation.
Fair enough. Actually, in India, because of the continuous rupee depreciation, we never lose 60%. Even in that period which you refer to, we actually rose 230%.
Yeah, exactly. Exactly. That's the point. So, because at that time, you didn't have any other dollar asset that you could invest in, dollar or hard currency asset.
Okay. Now, let me come to the next FOMO, or rather the next fascination of the market now, IPO. And, every now and then there comes an LG IPO, which lists at 50% premium. And then once again, you feel, is this a bubble? Was I wrong not to have, thrown my hat in? Of course, even if you had thrown your hat in, you may not have got it. So can you advise people on how they should approach this ongoing frenzy of IPOs?
My advice would be that when there is an IPO frenzy, when markets are like in the IPO side at an abnormal kind of interest and money coming in, it almost never makes sense to invest in the IPO. And the reason for that is that usually when there is the frenzy, first of all, most IPOs will be overpriced. Yep. But the second part is that suppose it is a sensible business at a sensible valuation, you're not likely to get much allotment. Yes. So this 50% is on whatever you got allotted, but on the money you put in, what did you get? Yep. And also it becomes like everybody is just playing the lottery. SEBI data, even this is old data, even 1.5 years ago, showed that if an IPO lists at a premium, 60 to 70% of the individual investors get out within a week. So you are not even looking at whether that company is valued correctly. Also, now this has become, even in a sense, a little more risky because a lot of IPOs have a considerable portion or sometimes even 100%, which is an offer for sale.
Yes.
Which means that the promoter and the so-called sophisticated investors are getting out at the price at which you are getting in. Okay. And most important of all, there are many new investors in the market who may not know this, that the demand for an IPO in the at the time of the IPO has absolutely no correlation with how the stock does in the long term. So we all know those stories of Reliance Power IPO, where there was this frenzy and then the stock went practically to zero. But even if you leave out those extreme examples, DLF is a good example. The company continued, but after the first few months, that IPO price did not come back for decades.
Yes.
On the other hand, I mean, recently somebody on a podcast said that maybe someone's parents or grandparents were lucky enough to get an allotment in the Infosys IPO.
That's right.
And then I actually messaged that journalist and I said, do you know that the Infosys
Bombed.
IPO undersubscribed?
Yes.
Money was, it devolved on the underwriters and the money
That's
was
right.
made by the underwriters. So it can be as extreme as that Infosys, which has been a big wealth creator, its issue was undersubscribed. And a whole lot of issues which do very well, the stocks never go anywhere. And also remember that about 2/3 of the companies that have ever listed on the Indian market no longer trade. They have, as I say, disappeared into the blue yonder. So,
and more so in times of frenzy, the percentage can be much higher in times of frenzy. Well, point taken. You have to do your homework and do the same math in terms of valuation. Incidentally, I think the LG IPO is only about 35 times its comparable companies. Havells and Voltas and all are trading above 40x. So perhaps in this one case, the feeling
only.
Yeah, only 35. You're right. Depending on which year, it can even be, more. Okay, Devina, it is customary to ask where will the market go next year. I know that it's a fool's game to ask, but then, people are disappointed. Over the past year, they've not made money in secondary markets. In fact, at an index level, we are down about 5%. So what's the sense? Are you feeling confident about earnings growth in the next 4-5 quarters?
Okay, first of all, Lata, in 30 years of being in the markets, I have never given a Sensex or Nifty target, either at the start of the new Samvat or in January, because it is a fool's game, as you said, and the term that Daniel Kahneman uses for it is objective ignorance. These are things not only that you don't know about, but you cannot know about. So, I mean, it's crazy to be confident about something you cannot know about. And Bloomberg actually did a study in the US, because there the data is available for decades, that what did all the so-called Wall Street stalwarts predict in January and what happened for the S&P 500. So this is like all the Morgan Merrill, Goldman and Citicorp and HSBC, all the people
storied people
know the market. Yeah. So on the average, the projections are off by 15% points. So if they say it will be up 5%, it can be -10 or it can be +20. And no one is anywhere, significantly less than that number. Everybody has a similar track record. Everyone every year projects that S&P will go up between 0 to 10% mostly, because that's a safe place to be in. But in 100 years, the S&P has been in that range only 14 years. So it's just, it's crazy. I mean, all the people who are saying whatever they're saying this, Samvad, go and see what they said in the last 10 years and what happened.
Fair enough. No, but regardless, do you see, the big problem for us has been 5 quarters of single-digit or low single-digit earnings growth. Is it looking like changing because we have put in lower interest rates, lower taxes, lower indirect and direct taxes? So is there a theme now in consumption? Is there a reason to hope for earnings growth here on?
It has been my view for the last few months that you will see an uptick in consumption. See, as it is the consumption trough, the bottom was 23, 24. It
That's
was
right.
Not before 25. But at that time, I was the only one talking about a consumption slowdown, because the market was still going up.
Yes, it was 4.4% personal final consumption in 23, 24. You're right.
21-year low. And it was only, people started talking about it when the market started to go down, by which time it had already started to accelerate.
Yes.
And now my view had been, one, inflation has come down, which is a big thing, especially food inflation. Not only is inflation down, in certain cases, the food prices themselves are down, which means that in the household budget, there is more room to consume. because earlier food was crowding out even daily use items. And the other thing is that inflation coming down, crude get coming down, and therefore petrochemical prices coming down also helps the margin level. So for the companies, there is a positive move on the revenue, positive on the margin. My earlier guess was that you would see that uptick in quarter two earnings, the July to September quarter. Now, GST, while it's a positive move, because of the confusion due to the GST in that quarter, and people sorting out what happens to pipeline inventory with distributors, with dealers, and consumers postponing purchases, it may not show up so much in Q2, but definitely in the third quarter, you will see the improvement, I think, pretty much across the board.
Okay. Well, that's good news. That's a good news to welcome the new Samvat. Finally, in your book, one of the big messages you give is don't be wrapped in a single market, single currency investment. I mean, you spoke about globalization. I mean, you're first global for a reason. I think since the Asian crisis, I've heard you speak about, going global. And also that going global doesn't mean going to the US. How just advise our viewers, how do you go global and not just US? Just get into one of the mutual funds which promise you these global investments?
Right now, actually, the mutual fund investment route is kind of closed because the cap has been reached, and there is no point buying anything at a premium to the NAV, because the day the cap is moved a bit, that you would lose that whatever 10-20% premium. And in any case, if you just want to buy one ETF, you don't need to add a layer of India cost. You can open a broking account and buy it yourself.
Okay.
But there are very few offering true global investments, and even fewer who have expertise in global investments, because we've been doing it since 1999. We've been members of LSE and NASD 99 and 2000. So they're very complex companies, and across the globe, there's a lot of companies. So because it is a cause for me that Indians do not invest overseas at First Global, we actually have a product that starts and gives you all assets, all geographies at $10,000. So that's my kind of contribution to the Indian cause, because private banks don't give that kind of product for less than $1 million.
Fair enough. Okay, that's very useful advice, actually, that such products are available. If it's available with First Global, I'm sure it's available elsewhere, but we need to look at those places. Just a final word, one sector that is exciting you now.
I'm not very skewed towards any sector, but from the last year, we've been overweight auto components and pharma healthcare. We've added a bit more in autos. Over 2025, we've added in FMCG, so we are significantly overweight there also now. Banks we've added, but we are not overweight.
Okay. Well, that's useful advice for those who are planning their own investments. Thank you very much, Devina Mehra, for ushering our Diwali show with so much color and so much useful advice. Have a great summer 2082 yourself.
Thank you, and same to you and the viewers as well. Have a great summer, and respect Lakshmi Ma, don't just worship her. That would be my message.
Oh, great advice. Thank you so much, Devina.